This is a run through of Fourways fish farms. On the left we have the data, and the right we have my spreadsheet. I'm going to follow the order of the income statement in order to go and find the data. So let's start off with sales. We can see here quite quickly there's a sales number here of 542,000. I'm going to highlight that yellow just to denote an income statement item. The direct costs, that's quite straightforward, or should be. That is 34% of the sales number. So sales less direct costs will get you a gross profit. Now we're going to go and find some of the expenses. So there's a depreciation expense. Let's see what else we can find here. Here's a general and admin expense. And then we are looking for a marketing and distribution expense. And that one is 5% of turnover. So that math should be pretty straightforward. Add those expenses up, subtract them from the gross profit to get the operating profit. Then subtract the interest paid. There's the interest paid, and that should give us here actually a profit after tax. Sorry. Give us a profit before tax. Next up is a tax amount. I hope you will find that over the page. There we go, 29% tax rate. And then last of all, we're looking for something that relates to a dividend. The dividend policy here is to pay out half of the earnings after tax. So that number is effectively half of that. That gets us to 39,923. Okay, let's head over to the balance sheet. Add the 39,923 to the previous year's retained earnings that was given to us. It was given to us there. So really what that means, if we just clarify it here, we could insert this. And we could say if there was a retained earnings here from the previous year, 224,180 would go in there. We're carrying this over and we're adding existing retained earnings. So that's actually a green number. It's a balance sheet number. All right, not retained earnings, ordinary shares. So here's 40,001 Rand shares. That goes in there. There's no share premium. That's in the second year. Add these two to get the total equity. Now we need to find a debt number. There we go, long-term debt, 680. Equity plus debt will get us total capital. Take the total capital number and plug it in down at the bottom for the net assets. Next up is fixed assets. Alright, so we need to find a number here that relates to that. Here we go. The net book value of the fixed assets at the end of the year was 914,300. Net book value says depreciation has been deducted. Great, so plug that one in. Alright, now we need some stock numbers. The stock on hand represented a stock turnover rate of exactly 6 times. Alright, so we want to go to the income statement. And we want to take that direct costs and we want to divide it by 6. And we're going to get a number 3713. And that is your stock number, stock turnover. So that's how many times they sell their stock, assuming 30 is an average. That's how many times they sell it in a year. Right, the debtors outstanding in the year represented 79,7 days. That's precise, 7 days. And we need to tie that back to the sales number that is all on credit. So take the sales number, divide it by 365, multiply it by 79,7, and you will have a debtors number. All right. cash on hand that was given to us. There's the cash. All right, so we can plug that in. Therefore, we've completed all of the current assets. The suppliers, there it is, 24,530. Plug that in there, and now we can solve for the overdraft using this formula. Okay, that's NA equals. So we have the NA, 90, that's this 984,103 number. We have the fixed assets. We have the current assets. We're solving for CL. And once you solve for CL, you get this number and take out the creditors, and therefore you'll be left with the overdraft. Okay, so that's the first year complete. Let's head on to the second year. All right, sales would remain static at 542,000, same number, still all on credit. Let's mark these as we go along so we know that we've done them. And operational inefficiencies were expected to push the cost of sales up to 36% for this year. So that's 36% of the sales. Sales minus direct costs will get us a gross profit. Now we need to go looking for some expenses. All right. So there's a depreciation expense that we can use. They've given us that. General and admin costs forecast to jump by 40% over last year. All right, so that's general and admin. Take last year's number, grow it by 40%. Marketing and distribution would remain at 5% of turnover. Okay, so you've just got to go and calculate those, plug them in, add up those expenses, get the total. Gross profit less the expenses gets us to operating profit. It turns out that they repaid all the debt, if I recall. Okay, so they did 2 transactions here, and this would pay, they would be able to pay back the entire 680,000 Rand, and therefore their interest expenses are 0. Okay, so that's the one we want here. Interest expense is 0, so the profit doesn't change. Taxation 29%. Let's see, tax rate is no change. Dividend policy are not going to change. Neither of them are going to change. All right, so therefore this is 29%. Get this profit, take half of it, pay it out as a dividend. 62,254 is our retained earnings number. Let's take that to the balance sheet. Add it to the existing retained earnings. Cumulative, we get the new number. All right, so next up we need to determine the ordinary shares and the share capital. So really what they're doing is they are doing an equity raising exercise. Funds would be raised by issuing 20,000 new 1 Rand shares. It was agreed that to pay a total of 172,000 for an effective 1/3 stake in the business. Okay, so let's do a little bit of maths. We do it on the side here. If we are going to take 172,000 Rand and we're going to split that across 20,000 shares, well, we can say we've got a share price here. All right, and this share price is, let's add a decimal place, let's see where we're at 8.60 Rand. All right, now that share price as it is now is made up of 2 parts. It's made up of a 1 Rand par value. Let's give this a heading. Par value is 1 Rand. That doesn't change. But now we have a premium. The premium is the 7.60 Rand. All right, so the sum of these two must come to 8.60 Rand. Okay, par value is 1, the premium is 7.60 Rand. So therefore the way the accountants do this is they say there are 20,000 shares at 1 Rand and there are 20,000 shares at 7.60 Rand. So there we've got the share capital. So take that share capital number, let's move that over. All right, take the share capital number of 40 and add to that 20, because that's the new share capital that's come in. So 40 plus 20 gets us to 60, and the premium was 0, and now it's up to 152. So the sum of these two will be 172,000, which is effectively what the story is telling us. We've just split it into two boxes. Now add those up, you'll get to the total equity. Equity plus debt, okay, there's no debt in this case, gets us to total capital. Take the total capital, plug it in down here. All right, making good progress. Next up, fixed assets. Right, so they say to us here that the land and the farm would be sold to a property company at the book value of 500,000 Rand. That's no profit or loss on disposal. Okay, so let's make this orange. Okay, I am colorblind. Let's make this green, 500,000. And what's effectively happened here is we've taken this amount and we've subtracted out of there 500,000. Now we must still subtract out a depreciation number that was given to us of 72,260, and with any luck, there we go, we come back to that number. So that's how that is calculated. Okay. All right, so next up is the stock number. I see here that it says something about a stock turn of exactly 6 turns. So same principle here again. We're going to go find the cost of sales over here, and we're going to divide it by 6, and that will give us the stock turn. The debtors, that had something to do with, here we go, debtor days would be down to 70 days. So we're going to go and take the sales number here, and we're going to divide it by 365, and we're going to multiply it by 70. That will get us a debtor days. The cash we're going to work out, I think they say here the overdraft has been eliminated. There we go. So that's going to be 0. And there's the creditors. So in this case, when we come back to our formula here to calculate for cash, let's move this over so we can see it. We've got the net assets. It's down here. We got it from the top. We've got the fixed assets. We did that calculation there. The current liabilities we're solving for CA. Get that number. Subtract out the stock and the debtors, and you then have the part that's left, that is the cash. And our balance sheet balances. Okay, so let's head on to the cash flow statement. Cash flow statement starts with operating profit and adds back depreciation in order to get the cash from trading or cash from operations. Okay, so those are just income statement items just to show you where they come from. There's the operating profit, add back the depreciation because it's a non-cash expense. Next up, to go and find the working capital components. So off to the balance sheet and follow the rules. If stock goes up, cash goes down. There's the difference between the two. If debtors goes down, cash goes up because that is customers paying sooner. If creditors goes down, that is cash going down because that means we are paying our suppliers sooner. Right, so differences when we are working with the balance sheet. So back to the cash flow, I've plugged those numbers in there. Okay, proceeds from the sale of assets. You sell assets, you receive cash. You decrease your loan, cash goes out. Effectively, this cash helped to pay that loan off. There's no interest expense because there was no debt effectively. It's not strictly true. I've kind of simplified it because it depends when in the year the debt is paid off. We've just assumed it was paid off early in the year, and therefore there was no interest for the portion of the year for which they did have debt. Just simplifying things a little bit. Here's the new share issue. So that's cash in, and then dividends must be cash out. Tax is cash out. And then you want to go and just do a sum here of all these items from the operating profit number here, or the adjusted operating profit, and hope that you have your signs correct Just remember what's going on here. We've got 5 sources of cash. Number 1 here is operations. Number 2 source of cash here is working capital. Number 3 is fixed assets. Number 4 is investing activity. Number 5 is shareholder activity. And then tax here is all on its own. So you need to deal with each one of those. All right. Also remember, this opening cash flow, this opening number is I did the calculation down here, it's cash minus overdraft. It's the net cash position. Because we haven't included overdraft anywhere in these transactions, therefore it comes out in the wash in the final 2 numbers. If you go and put under financing activities here an overdraft number, which you could do, then what you'll get here at the end are the cash numbers. But what we're getting here are the net cash, and by net cash I mean it's net of cash and overdraft. It turns out that in the second year we do get the net cash, but the overdraft is 0. And it's important to notice that this cash flow, this closing cash, must be the same as the net cash position in the balance sheet. All right, so there we have it, a quick and dirty run through on the Fourways Fish Farm numbers.